It's Tuesday, February 3rd, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, a US-India tariff agreement, just the latest Indian trade deal. What does it mean for the country's economic outlook? But first, we are days away from Japan's lower house election, and it's a big one. This is Sanae Takaichi's major gamble after she was appointed head of the Liberal Democratic Party last October. That's when she became Japan's first female prime minister. So in this election, she is trying to turn massively positive approval ratings into a stronger mandate, but it's not without risks. Even before she got on the campaign trail, JGB yields were rising, the yen has been weakening, and it all culminated in this big sell-off towards the end of January. I want to find out why investors have been getting nervous and what this all means for Japanese macro and markets. So I'm happily joined by APAC head Marcel Thieliant and by APAC markets head Tom Mathews. Hi, Marcel. Hi, Tom.
Hi, David.
Hello.
Marcel, let me start with you. There does seem to be a lot more attention on this Japanese election than any I can remember. What's at stake here?
You could look at it from a political perspective. The LDP lost its majority in both the lower house and the upper house for the first time in at least 15 years. So there's a lot of at stake politically for PM Takaichi. She wants to regain a majority in the lower house to push through any legislative agenda that she has. But why it matters for markets? It's obviously against the backdrop of this inflationary reawakening that we've seen in Japan over the last few years. So bond yields were already rising over much of last year, but they started to rise more sharply again after Takaichi became prime minister. There's been two drivers of this. So the first is she had been quite critical of monetary tightening by the Bank of Japan. So at some point she said rate hikes are stupid, and there was some concern that she would prevent the Bank of Japan from tightening monetary policy as much as they should. And that in turn contributed to a rise in inflation expectations. The other factor is that she's been very vocal about expansionary fiscal policy. So shortly after she became prime minister, she passed a quite large supplementary budget. Now, supplementary budgets in Japan are passed every year, but this one was much larger than the one in the previous year. And then just 2 months later, in the run-up to the snap elections that she announced in the middle of January, she decided to suspend the sales tax on food for 2 years. It's not clear when that will happen, but probably next year. And that will cost another almost 1% of GDP. So 2 consecutive sharp fiscal loosening within 2 months against the backdrop of already rising bond yields. And that caused quite a big sell-off in the bond market in the middle of January. And the key question then is, if she wins a stronger mandate, will she continue on this reflationary path, or was it just an election gambit to boost her approval ratings in the run-up to the elections? We think it's the latter, but obviously the jury on that is still out.
The latest polling suggests that she might win an absolute majority. The LDP might secure that majority that you said they lost. They might regain it. With all that you've said there about the signs that she is fiscally dovish, you said she thinks the rate cuts are stupid. What are the implications if she does get that? Is that positive or negative in terms of the sort of the inflation outlook?
If she does get a large majority, she could overrule the upper house when it comes to budgets. So in the upper house, you would still not have a majority. But in the lower house, a simple majority is sufficient to pass budgets. So she could easily push through a more inflationary agenda in terms of fiscal policy. And if she does get a 2/3 majority, which some of the polls suggest, she could even overrule the upper house in all legislative matters, which would give her much more leeway to conduct any kind of policies that she wants. Now, from our perspective, in terms of the outlook for monetary policy, we don't think it matters really. Since Takaichi came to power, she's stuck to the long-standing line among Japanese governments that monetary policy is up to the Bank of Japan to decide. And the Bank of Japan did raise its policy rate last month. So it doesn't seem to be the case that the government is preventing the bank from tightening policy. Again, the key question is, to what extent will she push through additional fiscal measures? Now, typically, the government does not announce additional fiscal loosening until the supplementary budget, which is due by the end of the year, unless there's major economic upheaval. And at the moment, the economy is looking quite strong. So at least for the next few months, our sense is that there probably won't be much more fiscal loosening. The fiscal policy will be relatively loose compared to the last years, but it won't be loosened any further.
Tom, let me bring you in here. I want to get the sense of how the market is viewing this election. Liz Truss, former British Prime Minister, her great legacy was giving her name to this idea of a Liz Truss moment. Takaichi was compared to Liz Truss towards the end of last year, something that she denied. How, with all that Marcel said about the signalling that's happened, that's come out of this campaign, how is the market viewing this election and the likelihood that we are going to get this sort of fiscal expansion?
Yeah, you're right. I think that investors have at times had a bit of concern about, or at the very least seen her as a supporter of looser fiscal policy. Especially late last year, we saw this so-called Takaichi trade where the curve steepened a bit, the yen weakened, and the stock market did really well. And, that combination has prompted some comparisons to Liz Truss, even though it's not identical to what happened under her. Certainly, the UK stock market didn't fare quite so well. Perhaps a fairer comparison is maybe Shinzo Abe, insofar as she's generally a supporter of somewhat looser fiscal policy, somewhat looser monetary policy. And that's how we'd seen the market react to her earlier victories, is to become the leader of her party, and also some of her fiscal proposals since. Now, the reaction to the election might be a little bit like that. Obviously, depends perhaps on the majority that she ends up with. But I wouldn't necessarily bank too much on a big repeat of the Takaichi trade. As Marcel said, it's possible that the implications of the election for the near-term path of fiscal policy are actually not as large as some people seem to think, and certainly for monetary policy as well. So perhaps some of the previous policy announcements and proposals have actually been a little bit more consequential than the election may turn out to be. I think another thing worth thinking about on that front is that we probably will see that market response to fiscal policy change over time. One reason for that is that inflation expectations in Japan, at least as far as we can tell from market variables, seem to be closing in on that 2% mark that is, of course, the Bank of Japan's target. And that makes a big difference when inflation expectations are below that, as they were even, of course, for most of last year, as far as we can tell. Fiscal stimulus boosts inflation, but it doesn't necessarily prompt such a big response from the central bank. Now, once we close in on that 2% point, and we may be getting there as far as we can tell, then the more fiscal stimulus the government promises, the more of a response you might expect to see from the central bank, and that would probably limit the gains for the stock market, although it might mean that the Takaichi trade becomes a bit more positive for the yen. But as I said, having said all that, she's the favourite. It's probably not as consequential on a fiscal front, and so our base case would be that there won't be a huge reaction.
So that big sell-off we saw 10 days ago-ish, is that all over now? Is the markets calmed down a bit?
I would be cautious about declaring any sell-off like that fully over. We've obviously seen some large moves, especially at the ultra-long end of the curve, and I think in particular in the bond market after that 10-year point, we are seeing a situation where demand is very weak, and I think the Ministry of Finance is probably still feeling out just exactly how that market is going to look in a world where the Bank of Japan has a much smaller balance sheet. And so in the meantime, we're just going to see a lot of volatility there and potentially big sell-offs in the future, especially around fiscal announcements, even if the longer run trend is probably that it calms down and the spreads at that part of the curve ease off. As for the yen, also hard to say. It was pretty disorderly before that speculation around intervention happened. And it's obviously been on and off like that over the past couple of years. So who's to rule it out from happening again? But for now, I think a reasonable base case is probably that things continue to calm down.
Okay, and then we had that moment where the yen was nearing 160. We had the intervention by the US, that so-called rate check. comments from Scott Bessent. Is 160 a line in the sand for the yen?
I think as much as specific numbers are important, it's at least as important how you get to those numbers. If the yen was depreciating because of some clear economic fundamental through 160, I don't think that they'd be quite so concerned about it. I think what gave them a little bit of a worry was that it seemed to be depreciating despite a lot of factors moving in its favor, yields being one of them, perhaps even real interest rates moving in its favor as well. So, and then it started to fall with no obvious driver late in the week after the Bank of Japan decision. So that's the sort of thing where I think a central bank looks at it and says, maybe we need to step in to make sure the market is functioning correctly, make sure the price discovery is working properly. And the fact that it was around getting close to that 160 mark probably helped. That is perhaps a level at which they start to look at it a bit more seriously. But as I say, I think if it went through that mark for a good reason, then they probably would just let it sail through.
Marcel, I want to bring you back here because we've been talking about, you mentioned Japan's inflationary reawakening. Tom just mentioned there the idea that real yields could be going positive. I mean, how convinced are we that inflation is entrenched in the Japanese economy now?
Quite convinced, I would say. Obviously, the initial pickup in inflation was an import cost shock. It was probably the largest import cost shock since the 1970s. But that then set in motion what the Bank of Japan likes to call a virtuous cycle between high inflation and higher wages. So the key moment was when in the annual spring wage negotiations, which play a key role in setting wages in Japan, the trade unions were pushing for ever larger wage increases, and that momentum has now been sustained for 2 years. We'll get the results of this year's negotiations in a couple of months, and from all the evidence that the Bank of Japan has gathered, we'll get another strong round of pay hikes this year, so that would be the third year. And obviously, the longer this dynamic holds, the more likely it is that inflation will eventually settle around the Bank of Japan's target. There's still some laggards in the CPI basket. So public services inflation is negative because the government is pushing back very hard against price rises. And rent inflation is also still quite muted. But rent inflation is now clearly accelerating. In Tokyo, it's closing in on the 2% target, and across the nation, it's also picking up. So the laggards in the CPI basket are also now showing signs of acceleration. So we're getting increasingly confident that inflation will sustainably settle around the bank's target.
And so the signs of, I think you mentioned there, just falling headline inflation we had in December, nationally, the Tokyo CPI as well, the idea that they're going to cut the sales tax. Do you still see disinflationary forces at work?
Obviously, again, the government is trying to push very hard against inflation because inflation is voters' number one concern in the polls, and probably a key reason why the LDP has done so poorly in elections since the end of the pandemic. It's possible that a decline in headline inflation triggered by government measures would undermine that virtuous cycle that we've seen in recent years. But the counter-argument is that the labor market is still extremely tight, and the trade unions might also argue that this is just a temporary slowdown, that the underlying price pressures are still quite strong. So our view is that the trade unions will succeed in pushing through big pay hikes for the foreseeable future.
What does this all mean in terms of the inflation outlook then? I mean, talk through how you see inflation developing over the next year or so. And then also, what does it mean for monetary policy? You've been saying for a long time that the BOJ would raise rates by more than most people are expecting. And they have started on that process. So talk about how the policy response to all of this develops.
Yeah, so we'll get quite weak headline inflation in the first half this year, potentially as low as 1%. But the Bank of Japan is the government in Japan often implements measures that influence inflation, sales tax hikes, energy subsidies, and so on. And the Bank of Japan typically strips those distortions out from their measures of inflation. So they will probably focus on adjusted measures that again strip out those distortions, and on those measures, inflation will probably still be quite strong. So the Bank of Japan's preferred inflation measure, which is inflation excluding fresh food and energy, will probably be above the bank's 2% target for at least throughout the entire 2026. And in that environment, we think there's a strong case for further tightening, given that the real policy rate is still very low, below any of the estimates of the natural rate of interest that the Bank of Japan has produced. So we are forecasting 2 more rate hikes by the Bank of Japan to 1.25% by the end of this year, which I think is broadly in line with what the financial markets are anticipating. But we think that the bank will ultimately lift its policy rate to 2% by the end of this decade, which is higher than most are anticipating, but broadly consistent with the idea that the inflation will settle around this 2% target.
Okay, Tom, talk about the JGB impact. What does this mean for yields going forward?
Yeah, as Marcel said, I think what it tells us is that the rise in yields is not a temporary thing, and if anything, those at the long end may continue to creep up, and certainly the front end has a fair bit more to go before we get back to normal. But it looks as though the Japanese bond market might slowly be turning into a bit more of a normal one, to be honest, where it's not pinned at zero all the time, where you have yields in that sort of 2 to 3% mark, perhaps similar to the European ones, and you start to see more normal volatility, a more normal yield curve slope, similar, as I say, to those abroad, and certainly it means that higher yields are here for the foreseeable future.
Yeah, a lot of what you and Marcel are talking about is this idea of Japan normalizing as inflation comes back, as yields start to rise. I suppose we should point out that the movements at the ultra long end, they're reflective. I think you hinted at that, but they are reflective, aren't they, on the fact that supply at that end of the curve is quite thin, liquidity is quite thin, so you are going to see these sorts of big moves relative to what's happening around the 10-year. But what does it mean? Taking a step back, let's look more globally. What does it mean for global markets when you have a world in which the 10-year yield is above 2%?
Yeah, it's a great question, and I think something that there's been some concern about as yields have started to rise up off the floor. Japan, of course, is a big net creditor, a big holder of foreign assets, a lot of which denominated in dollars, owned by institutions like its pension fund, the government pension investment fund, for example. Its FX reserves as well, huge holders of US treasuries, for example, big investors in corporate bond markets and equities as well. So there's always this concern that they were doing that because they couldn't get any yield at home, and if interest rates rose, then maybe they would start to repatriate those funds. There really isn't much sign of that happening yet, certainly not to any great degree. And I think people that were concerned about that could probably take some heart from the fact that global bond markets have generally held up quite well to that rise in Japanese yields. Obviously, there's been some reaction on some specific days and so on, but I think in general, you'd be hard-pressed to see a huge negative effect from that rise or any particularly large effects of Japanese capital repatriation. Now, some part of that might be a technical thing. The hedging costs for Japanese institutions that want to buy foreign bonds will tend to reduce as the Bank of Japan hikes rates as its policy rate gets closer to those elsewhere, because those FX hedging costs depend as much on the slope of the yield curve and in particular the difference in short-term interest rates. And so in that respect, actually, the attractiveness of foreign bonds hasn't necessarily diminished all that much for certain types of Japanese investors, those that like to hedge the FX risk. But it's also the case that foreign assets will always be attractive to big diversified institutions. And I think that the risk of a huge repatriation of capital, a huge sell-off in global markets, I mean, it's really, if it was going to happen, it already would have, I think, at this point, and probably, I would say it's fairly unlikely.
And a related question is the carry trade, the risk of a disorderly unwinding of the carry trade as Japanese rates rise. I mean, we saw what happened in mid-2024, the volatility that was caused around the BOJ raising rates. Risks of a repeat of that kind of episode?
Yeah, I think as long as the Bank of Japan is hiking in a fairly steady manner, which so far seems to be the case, The carry trade probably isn't too much a threat. Obviously, we've seen a few disorderly rises in borrowing costs and so on, but the real threat often seems to be just a big rally in the yen. That was certainly what we saw. Now, a couple of years back, it seemed to blow up the carry trade when the yen appreciated very strongly. Now, the things that we look at, the various measures of how heavily used the carry trade is, don't suggest that there's a whole lot of it going on at the moment by past standards. And maybe that's why the most recent rally in the yen doesn't seem to have really knocked global markets off course as much as perhaps the other one, the earlier ones have. So perhaps that's a sign that the carry trade is already starting to sort of naturally unwind. I don't think it's a huge threat, as I say, unless Japanese borrowing costs were to rise very sharply and unexpectedly. And certainly the caution that the Bank of Japan has displayed so far suggests that that's pretty unlikely.
Marcel, with all that you and Tom have talked about Japan's return to inflation, about yields rising, about the BOJ tightening more, as I say, we have got this election on Sunday. It is a big moment for Japan politically, as you described, economically as well, perhaps. So just to wrap up, what are the kind of risks that investors should be looking at around this election? Where do you think our forecast could go wrong?
I guess the main risk is that Takaichi does implement further stimulus measures over the next few months. It might not happen immediately after the election, but it could happen over the next few weeks as she consolidates her power. And in that case, I would expect there to be additional upwards pressure on long-term bond yields. I mean, as Tom pointed out, the increase in bond yields so far is broadly consistent with Japan's economic fundamentals. So markets now expect inflation to settle around the 2% target, and real yields are still quite low. There's little evidence of any fiscal risk premium. So if you look at the CDS spreads on Japanese bonds, they're still quite low. But there is a risk that if she does push it too far, that risk measures will eventually start to pick up and bond yields do rise more sharply. And in that case, we might eventually get a response from the Bank of Japan. The Bank of Japan will review their bond purchase plan in June. So it's possible that they adjust the scheduled tapering of their bond purchases. And in a severe sell-off, it's possible that they might even conduct some emergency intervention, which so far they've been reluctant to do, not least because they also think that the rise in bond yields so far has been in line with fundamentals.
Marcel Thieliant and Tom Mathews there on a pivotal Japanese election and the country's inflationary reawakening. Voting is this Sunday, and the team will be doing a drop-in, that's one of our short-form online briefings, on Monday at 5 p.m. Tokyo time, that's 8 a.m. London. They're going to be discussing the results and the implications for the policy outlook and financial markets and answering all your questions. We also have a dedicated page on our platform which houses our key Japan analysis, all about this normalization, and I'll link to that and to the drop-in the podcast notes. Now, Shilan Shah, who leads our India coverage, was meant to be on last week's show talking about the India-EU trade deal, but then news of Kevin Walsh's nomination to the Federal Reserve chair came through and we had to put that one on ice. Probably a good thing, because news came through on Monday that the Modi and Trump administrations have done a deal that will lower reciprocal tariffs and see India stop purchases of Russian oil. It gave me a chance to catch up with Shilan again and get a sense of what's been behind India's recent flurry of trade agreements.
Yes, I mean, I think the ironic thing is that India has been pursuing these trade deals as a means of ensuring global market access, but also reducing its economic dependence on the US. So if we look back over the past sort of 9 months, trade deals with the UK, Oman, New Zealand, and then last week we had the EU as well. So signs there of policymakers taking a more liberal approach to trade, reducing their dependence on the US. But of course, the big one was the US itself. So the reduction in the tariff rate from 50% to 18% makes Indian exports to the US look far more competitive than they were. They're more in line with tariff rates faced by other countries in Asia, such as Vietnam, Indonesia, and the Philippines. That's really good news for exporters, particularly of tariff-hit sectors such as textiles, gems, and jewelry, which which had been struggling under the weight of tariffs, even if tariff-exempt sectors such as electronics had been doing very, very well. So all of that should help to support growth in the near term. But when we think about the trade deals collectively, then I think that's more of a longer-term positive for India. What it does is force local firms to be more competitive, to find efficiency gains, to find productivity gains, and that's something that's going to bring benefits to the economy over the longer term.
So just looking at that US-India deal, how much immediate relief does it bring? Does it move the dial in terms of your near-term forecast for India?
I think so, yeah. When we look at the aggregate numbers, so aggregate goods exports to the US, they have held up pretty well, even since the 50% tariff came in. But that really reflects the strength in the tariff-exempt sectors such as pharmaceuticals, but also electronics as well. And actually, sectors such as textiles, gems and jewelry had been faring a lot worse. There was some support measures announced in the union budget for those sectors over the weekend. But now that we have this trade deal, those sectors start to look more competitive. And so ultimately, we think that's going to probably help to lift growth by another 0.2 to 0.3 percentage points over the next couple of years. We were already forecasting growth of 6.5% for India. So in any case, a global outperformer. And I think that this is going to lift GDP growth to perhaps something closer to 7%.
And what about India's pledge to stop buying Russian oil? Is that something that happens immediately? Are there questions about enforcement? And where does India buy its oil from now on, if this is the plan?
Yeah, this is a really interesting aspect of all of this, not least for the geopolitics. It feels to me that orders from Indian refiners for February have already gone ahead, which means that if we do see a fall in Russian oil imports, that's not going to show up in the data until at least March, and probably more realistically, it takes a while to really wean itself off. There is a question, of course, about whether it's actually going to happen in any case. India and Russia have very long-standing relations, so I think it would be a very, very big step for India to essentially be strong-armed into reducing its oil imports from Russia completely. India prides itself on geopolitical non-alignment. This feels like something that would very much sort of be dragging it back, I would say, into the US-led bloc.
It's an important point that I just want to come back to. You said that the deals with the EU and with these other trading partners, they'd been pushed over the line, pressured in part by what was going on with the breakdown in India-US relations, the fact that trading relationship had suddenly been scuppered by these purchases of Russian oil. So now you've got a case where not only have you got these trade deals with the EU, etc., but they've worked it out with the US, they've got those tariff rates down. I know that you and the team are currently in the process of putting together, it's our annual exercise of updating our long-term forecasts. As part of that exercise, India looks very good in our forecast out to 2050 in terms of the economy's potential, one of the brightest stars among the major economy, if not the brightest. All of these trade deals that have been agreed in totality, assuming that they do what the details suggest they will do, how does that shift our longer-term view of India? Or does it just reinforce the idea that India really is going to be one of the outperformers through to mid-century?
Yeah, so I think there's a couple of points to be made here. So starting point, we already have a very positive view on long-term growth in India. The demographics are very strong. That's really in contrast to lots and lots of other countries in Asia, but also globally. It still has lots and lots of scope for productivity gains. So the fundamentals were always there in terms of India's sort of long-term trajectory or potential. Then there are some points to be made around the trade deals themselves. There's a question mark around, firstly, whether the India-EU trade deal will get ratified. I mean, we think it will, but that's only because there have been some certain sectors, politically sensitive ones, that have been left off the table. So that already starts to dilute the scope of any deal. So these aren't necessarily really big sweeping trade deals. We're pretty skeptical on Trump's claim that Indian tariffs on imports from the US will fall to zero. I think there's still going to be many sectors of the economy that are kept behind high trade barriers, particularly politically sensitive sectors such as agriculture again. So that perhaps limits the scope of some of these deals. Having said all of that, though, yes, I think when we look at it collectively, trade deals with some very, very major economies over the past year or so, that is really good news for exporters. But what it also does is force local firms to face up to more global competition, which then makes them find efficiency and productivity gains. And that starts to look a lot more positive over the long term. And what's also interesting is that that's all externally focused, but domestically as well, we've seen some pretty big sweeping reforms over the past 6 months or so, including to the labor market, but also the tax code as well. So collectively, I think we need to be factoring that into our long-term forecasts. And as we said, we're already very positive on India's long-term growth outlook. And I think that this means that there's potential for the economy to grow even faster than we're currently forecasting. We think that growth will average about 5% from now until 2050, which leaves India as a global outperformer. Once we start to factor in these reforms, both externally and domestically, then it could be something closer to sort of 5.5%. That's really going to cement India's place as the world's third largest economy. We think on our forecast, it's going to overtake Japan pretty much imminently in the next year or so. Germany is then by the end of the decade, and then really just take off thereafter and leave both of those countries trailing in its wake.
Shilan Shah on India's trade deals and its long-term economic outlook. That annual update of our long-term economic forecast will be out in the coming couple of weeks. There's an accompanying markets outlook as well, so watch out for those. We're also continuing to track shifting tariff rates and their impact on the global economy on our platform, capitaleconomics.com. You can always drop us a line to learn more about our coverage or to give us feedback on this podcast at podcast@capitaleconomics.com. But that's it for this week. We will be back next week with more global macro and markets insight from Capital Economics. Until then, goodbye.